When you think about I think about my past as a news anchor. A lot of this is not necessarily intentional. It's not agenda driven, but we just something as simple as reporting how the stock market closed on a daily basis. We ran the actual number every day as a kind of a throwaway thing at the end of a segment. But it became a news story if it was down big.
Oh, yeah.
It was never a news story if it was up big. So you think about the perception of if somebody just got their information from one source that, well, the market's always bad. And the reality is market volatility is always going to happen. It is not. I told a client this morning, actually, we were talking about the market being at all-time highs, and he's a little bit fearful of where we are. And I always try to give them that expectation that it's probably going to have a pullback at some time in 2021, and that's not uncommon. If we go down 10%, if the S&P goes down 10% sometime this year, it's not uncommon, and it doesn't mean the world is ending. But you don't want to sell when that happens, when it's on its way down, or even try to get back in after it goes back down.
Scott, you talked about that 10%. We would call it a correction, a 10% correction. And it is very common when you look at a year that is on December 31st, a positive year in the market. It is incredibly common for there to have been a 10% correction. So it feels very ugly at the time. The question is, what do you do about it? When you think that things are going awry, how do you respond? And we've actually got a graph we're going to share on this to kind of show you the difference that it can make on your overall investments, because if you stay in, then you're experiencing the lows, yes, but you're also experiencing the highs. So let's look at this here. This is from January of 1980 through March 31st of 2020. This is the growth of a $10,000 being invested in the S&P 500. Now, just to clarify, you can't invest directly in the S&P 500, but this is what would have happened in this situation. If you invested $10,000 and you stayed in, and by the way, March 31st of 2020 was at a very low point. That was right after the downturn from COVID. So if you stayed in that entire time, your $10,000 would be $697,000. If you'll allow me, for rough numbers, that's basically $700,000 after that 40-year period of time. But if you missed the best 50 days, you're down to $48,000. Now, would you rather have $48,000 or $697,000? Now, the guy who has $697,000 figured out somehow how to, make it through those rough days and not be focused on that.
Yeah. It's about the why. If you understand the why and you understand how volatility works, it's not as scary. In my RICP class, one of the lecturers on there said something to the tune of volatility only matters when it hurts. Right. And volatility is your friend in many cases when you're accumulating. But if you're on that end of the spectrum where you are now in retirement or entering retirement, having a plan is so critical to avoid selling when it's down.